Hi, my name is Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about the Smith Maneuver, and many of you have asked for this video, so we thought we'd finally release it and just go through the Smith Maneuver, what it is, how it works, if it interests you, how do you set it up, and then just some kind of, pitfalls and issues that we see with it. And at the end of the video, I'm also going to talk about how I kind of roll out my own Smith Maneuver. I don't do the Smith Maneuver to a T. I do something a little bit different that works really well for me. We've done it for a lot of our clients. I will say Smith Maneuver is borrowing money to invest. It's not for everybody. So understand the risks of it. The Smith Maneuver carries many risks. So do your due diligence. This probably doesn't fit the mold for a lot of you. But again, a lot of you are asking for this. So we thought we'd just break it down. And from a financial planning perspective, where are the benefits to this and what are the drawbacks? So we'll go through that in this video. So the Smith Maneuver was created by a financial advisor back in the 70s named Fraser Smith. And his philosophy, or the concept behind the Smith Maneuver, was that in the US, you could deduct interest on your mortgage. And he thought that wasn't fair. So he wanted to create a strategy where we could create some deductibility through our mortgage or assets or equity in our home. So that's where the Smith Maneuver came from. Okay, so what the Smith Maneuver is, I'm going to kind of dumb it down so we can understand it as simple as possible. And what it is, if you take out a mortgage, let's say you take out a mortgage for $400,000, okay? As you pay down your mortgage every month, part of your mortgage payment goes to principal and part of it goes to interest, okay? The concept behind the Smith Maneuver is that, let's say you pay $1,500 each month to principal, okay? As you pay down that $1,500 to principal, it gives you more room or more equity in your home, and you borrow back that same $1,500 and invest it. Okay, by borrowing to invest, you can deduct the interest. Okay, so what you need is a re-advanceable mortgage. Okay, what that means is as soon as you pay your monthly payment to your mortgage and you lower your mortgage by $1,500, you can re-advance that immediately. Okay, most financial institution and mortgage lenders will set up a re-advanceable mortgage for you. Okay, so that's not out of the norm. I have my mortgage through Scotiabank, through my independent mortgage broker. It's a step mortgage, and it has that re-advanceable option. So if you need to or are looking to set up the Smith Maneuver, you need to make sure that your mortgage has a re-advanceable piece to it. And again, all that means is as you pay down. So in simple terms, let's say your mortgage payment was $3,000 a month, and half went to interest, half went to principal. That $1,500 that you went to principal, you could immediately borrow back that $1,500. On kind of a second piece, a re-advanceable piece to a mortgage. It's separated from your original mortgage piece, and you could borrow that and invest it in a stock, a mutual fund, real estate, something like that. Something that you're borrowing to invest, that investment's long-term, and you can deduct the interest. So it's what we'd call good debt because you can write off the interest for that. In simple terms, that's how it works, okay? Again, you're paying down your mortgage. Whatever principal amount you pay down, you borrow right back on the other side, you invest it, and you deduct the interest there. Now, my concept and my kind of thought around that is, well, that makes sense, okay? You're creating an investment piece that you can deduct the interest on, but is that necessary in the first place? And it seems like a lot of work to me, right? Every month you have to pay your mortgage, and you got to go in and borrow back whatever principal amount you paid down, throw it into your investment account. There's a bit of a process to that, okay? And you need to make sure that you set it up properly from the beginning. Again, you need to have a re-advanceable piece to that mortgage to be able to do the Smith Maneuver. It's not a home equity line of credit, because a home equity line of credit isn't always necessarily available to you the instant that you pay down your mortgage more, okay? It's only going to be that way if it's re-advanceable, okay? So it has to be set up that way, okay? You can't just say, I need a home equity line of credit against your mortgage, against your house, and then have access to it right away like you would in the case where we're looking at the Smith Maneuver, okay? So again, the Smith Maneuver, as you pay down principal, that is quickly borrow back, invested, let's say in stocks or ETFs, mutual funds, whatever it is, and the interest that you're paying on the money that you borrow back out of on that re-advanceable mortgage is tax deductible, okay? So that was his concept of let's take your bad debt, your mortgage, which I consider good debt because it's where you live. Your mortgage on your principal residence, even though you can't deduct the interest, I see it as good debt because you're living there. It's long term. If you look at it through a financial plan and financial picture, it is good debt. So I have no problem with a good mortgage as long as you can afford to pay it. As interest rates will now start to climb up, can you still afford to pay your mortgage if rates go up 1, 2, 3%? If you can, it's good debt, move forward with it. But the concept is now when you pay off your mortgage and you're creating more equity in your home, you're taking that equity immediately, borrowing it back out and investing it and writing off the interest. Now, of course, when you write off that interest, you'll get a bit of a tax break on that. You can take that and either pay down your mortgage faster. There's different tools. So you can kind of roll out that Smith maneuver in a few different ways. I know a lot of people that use the Smith maneuver. What they'll do is they'll borrow that money back every month as they make their mortgage payment. Then at tax time, they can deduct that interest that they paid. So what they do then is that they take that tax refund, let's say it's $2,000, and they'll put it down on their mortgage. They're going to lower the amortization on their mortgage and pay off their mortgage faster. So there are some side benefits, absolutely. Plus, you have this investment account. The end goal is once you've paid off your mortgage, you have an investment account that would be equal to, or you borrow it out, equal to about 80% of the value of your home, which is what most lenders will give you. So again, if your home is worth $500,000, again, you've originally had that $400,000 mortgage. Now you have a $400,000 investment loan. Hopefully your investment account has grown beyond that, but you're able to deduct that interest. Now, again, you have a debt still of $400,000, but it's a good debt because you can deduct the interest on that. So let's say you've done this over the years, over your 25-year amortization, you no longer have a mortgage, you have this $400,000 loan that's collateralized against your house, but you can deduct the interest because you've invested that money, and hopefully the investment account is at $700,000, $800,000, $900,000 or more. Now, eventually, you want to pay off that debt probably as you enter into retirement, but the concept would be, the investment account's worth $900,000, the loan is worth $400,000, you're going to pay off the loan, you're still left with $500,000, and you have your house paid off. So you're just leveraging the equity in your home. That's essentially what the Smith maneuver does. It leverages the equity in your home. You're borrowing against it on an ongoing basis. You're deducting the interest. And at the end of the day, as long as you're getting a higher rate of return on your investments than you're paying on your interest, that spread should make sense and you'll be better off in the long term. So in theory, to set up your Smith maneuver, there's 4 steps to it. So step number 1 is to open up a re-advanceable mortgage through your mortgage lender. Okay, so that's step number 1. Step number 2 is to have that re-advanceable mortgage. We're going to call it a HELOC for simplicity. It's basically the equity in your home as you pay it off. You want to have that set up and you're borrowing against that and invest in it. Okay. Step 3 is you're going to use the tax deductibility on that. So step 3 is you're borrowing money out of there, you're investing it, and that interest that you're paying on it is tax deductible for tax purposes. Step number 4 is come tax time, when you do your tax refund, you can deduct that interest amount that you've paid on that borrowed amount. You're going to get a bit of a tax refund and you either reinvest that back into something or ideally you pay down your mortgage. So those are the 4 steps. And ideally you just repeat that year after year after year. So I think when we talk about the Smith maneuver, the number one important thing to look at by far is risk versus reward. Okay. As I mentioned earlier, when we talk about the Smith maneuver and looking at rolling that out maybe for yourself, it's a huge risk there in that you're borrowing money to invest. Okay. So when you borrow money to invest, or when you invest anytime, obviously there's risk to it, right? There's behavioral risk. Markets are down. Do I panic and sell out? Getting into the wrong investment in the first place. There's a lot of things that can go wrong with investments. And many of you watching this video, you've had those experiences, okay? Now, if we start leveraging the equity in your home to invest, obviously that can also go sideways. It's an investment. It's treated the same way, okay? So before you think about, okay, yeah, this can build wealth, if done right, the Smith maneuver or just borrowing equity out of your home, when done right, it can be a good strategy for some, okay? If your investment returns outweigh the interest you're paying, you don't make bad decisions along the way, you don't panic, you invest in the right things, all that kind of stuff. It can work out well. You can build your net worth quite substantially over time by using the equity in your home. Again, whether it's through the Smith maneuver or any other method that you want to use to pull equity out of your home. The other piece of the pie when you look at risk versus reward is anytime you invest, you want to have time on your side. And I know a lot of our viewers are close to or into retirement. Now, when you retire, let's say you're 65 years old, you still have a time horizon for investments of call it 20, 25, maybe even a bit longer years. So you still have a long time horizon on that. But anytime you borrow money out of your home, again, Smith Maneuver or otherwise, you want to make sure that you have time on your side and that you can give that investment time to work for you, okay? As we know, you could throw money in the market today and it may be down 20% tomorrow. That's a possibility. And that's why anytime you borrow money, when you leverage that asset to invest, you need to make sure that you give it enough time to work and do the thing it needs to do, okay? So that's the other big risk here. If you don't have enough time on your side, then doing a Smith maneuver or borrowing to invest or leveraging, doesn't matter which way you cut it, it's probably a bad idea for you. So if you're considering a Smith maneuver, right? If you've watched this video now, maybe you've done some homework on the Smith maneuver and you're comfortable with borrowing money out of the equity in your home to invest, to build long-term net worth, build wealth outside of your home, then there's a few things you need to consider. First off, you need to make sure that you track it properly, okay? Anytime that you're deducting interest on an investment loan, you need to make sure that it's separated out properly, you're tracking it properly. When you do your tax filings, everything's checked off properly, okay? So make sure you're doing that properly. Tracking the interest, writing it off, tracking the earnings, all of that needs to be kind of, tracked properly there. So that's number one, make sure you look after that properly. Anytime you borrow money to invest, you need to make sure that you're not putting that money into an RSP or TFSA, okay? You can only deduct the interest, and this is a very, very important part. You can only deduct the interest if you're investing in a non-registered investment account, okay? If you borrow money, either it's out of your home through a Smith maneuver or any other way, if you borrow money to invest and you put it into an RSP or a TFSA, you cannot deduct the interest. Okay? It has to go into a non-registered investment account. Now, what are the drawbacks with a non-registered investment account? It's that anything that you earn on that account every year, whether it's income, dividends, or capital gains, are going to be taxed in that year, okay? There's no tax deferral or, no tax at all in a TFSA. You don't get that benefit, okay? So yes, you can deduct the interest every year, but you need to make sure that you're claiming and paying taxes on any capital gains, dividend, or interest income that you've earned in that non-registered account, okay? So with the Smith maneuver, the same thing. You need to make sure that money is being allocated to a non-registered investment account. It could be joint, it could be individual, that's fine, but it needs to be non-registered. I think what's important too with the Smith maneuver, much like borrowing money out of equity out of your home in any way, it doesn't take away the principal resident exemption, okay? Because you're borrowing money out to invest, you're keeping that kind of sideways, even though you're using the equity in your home to do that, your principal residence is still your principal residence. So applying the Smith maneuver to your mortgage, to your property, or just borrowing money out to invest, it does not take away that principal residence exemption. So just be aware of that. There's no harm in doing this in your principal resident exemption. As we know, that can be very beneficial, at least right now. That may change down the road, depending what the government rolls out here. But currently, having that principal resident exemption, it's obviously a huge tax advantage, and doing the Smith maneuver does not hurt that. And the last thing I want to say that you need to consider, the Smith maneuver, borrowing to invest, leveraging, it's not for the risk averse. And a lot of you're getting close to retirement. I don't think now is the time to take more risk. And definitely borrowing money out to invest, it carries risk to it, right? You have to have the stomach for that. You have to have the longevity for that. And for most of you entering to retirement, there's not a need to kind of build that more wealth. You probably have enough money already. Like, are you taking more risk than you need to? Is there a need to do this, right? And I think that needs to be step one is, yeah, I'm a little behind. I'm comfortable with the risk. We have equity in our home. We need to do this. Or maybe you're 5, 10, 20 years from retirement and you're looking to do that, fine. If it fits the mold, then fine. But a lot of you getting close to retirement, it may be a risk that you don't have to take. So make sure that you adjust that first. But definitely the Smith maneuver is not for the risk averse. If you don't like risk, borrowing money should not be your thing. Do not do it. It'll keep you up at night. It'll cause stress. Please don't move forward with the Smith maneuver or any other type of leverage or borrowed investing. Now, the last thing in this video I want to cover is what I've mentioned at the beginning. I want to go through what I do actually, like personally. So my wife, Steph, and I, what we do on our end is a little bit different. We don't roll out the Smith maneuver. I just see it as way too much work. Like, to do that every month, it's just, I don't have the time and the effort and the energy to do that. One thing with the Smith maneuver, yes, you're getting dollar cost average. You're putting money in maybe every month or 2 weeks or whatever your mortgage payments are. So you're dollar cost averaging in, but I just find it like tedious and too much work on my end. What I prefer to do is every 5 years, when my mortgage comes due, as I build up equity in my place, or as my place goes up, so I'm paying down my principal, I'm also building equity as the properties have gone up in value. When I get to my 5-year renewal on our mortgage, then we'll look at like how much equity do we have that we could maybe borrow out, and we do a separate 5-year mortgage against that amount. Okay, so we actually have our mortgage coming up in January, and just this week I sat down with my mortgage broker, kind of hashed out a few numbers, and we figured out how much we'd have available to us to borrow. So we have our main mortgage still. We have a young family. We're still, have a mortgage and paying that off, but we have a bit of equity in our home. So what we're going to do is we're going to do a second mortgage. We're going to do a 5-year term. Still going back and forth on variable versus fixed, but we're going to do a 5-year term. So it's not a home equity line of credit. It's a 5-year term mortgage. Okay. So our main mortgage we have, then we're going to have a second mortgage, and that's going to be used to invest. Okay. Now the benefit with doing a mortgage versus a home equity line of credit, which you would be using in the Smith Maneuver, is you're paying a higher interest rate. Okay. So right now prime is 2.45%. Okay. Any line of credit out there, you're going to pay prime plus half. So you're at 2.95%. Okay. So if you roll up the Smith Maneuver, that's what you're paying, 2.95%. Okay. With my mortgage, I've actually locked in right now on a 5-year variable rate mortgage at 1.35. I could have done a 5-year fixed at 2.25. Okay. Super low. Okay. So 1.35 versus 2.95. Now I know my variable can creep up over time. I'm okay with that. Okay. But the benefit to me is I'm taking that chunk of money, I'm going to take it on a 5-year term, I'm going to invest it with BCV. They're going to hopefully do well on the investments with that and earn much more than the 1.35, or a slightly more interest rate that I'll pay over time. But that's how I do it. So instead of kind of doing the ongoing thing and doing the home equity line of credit at the higher rate, I prefer every 5 years. What I'm comfortable with pulling out depends on what we want to do with, other things going on in our life. Come up this January, we don't have a lot going on. We have some equity in our home that we're comfortable kind of tying up into, leveraging out, tying up into an investment for at least the next 5 years. But our plan will be after 5 years, my plan is just to renew that piece of the mortgage and keep writing off the interest and keep letting the investments grow. Eventually, at some point down the road, we'll pay off that mortgage piece, and we'll have a bit of, growth left from the investment. Okay. Now, again, the other side of this, the last piece of this I want to touch on is the difference between, having that mortgage piece like I set up versus a home equity line of credit. Okay. On a home equity line of credit, it's a higher interest rate, but you only have to pay the interest. Okay. There's no principal portion that you need to pay back. With a mortgage, you have interest and you have the principal. Okay. So your monthly payments are going to be more. Okay. So you have to be able to make those monthly payments. If it's, I don't want to make monthly payments, I want to pay interest only, I'm okay paying a higher interest rates, then set it up through a home equity line of credit. Again, it can be set up like I do, where I kind of do it every 5 years, or Smith Maneuver, where it's done, every 2 weeks or every month, or however often you pay your mortgage payments. Okay. Two options there. Again, if you set up as mortgage like I do, you're going to pay mortgage payments. Your monthly payments will be higher, but your interest that you're paying will be lower. I kind of like that. I think my money's working better for me. Alternatively, you could go to the home equity line of credit. You're going to pay a bit higher rate, but interest only payments. Okay. So two good options. Again, I don't see the Smith Maneuver as, yes, your dollar cost averaging in, but you are paying that higher interest rate. It's a bit more, you got to be more involved with it. There's more kind of hand holding and watching, that kind of stuff. I'd rather just look at it once every 5 years. I also think that if you're doing this every month or every 2 weeks, you're going to be watching your investments too closely, and you can make a bad decision really quickly. For me, myself, like in January, I'll take out the second mortgage, I'll give the money to BCB to invest, and I'll check in on it once a year, but I don't watch it. I'm not worried about what it's doing. I know it's going to work for me long term, 5, 10, 15 years. I'm not going to worry about it short term. And by doing it the way I do it, I don't have to worry about it. I pay my mortgage payment on that piece, and I let the investments roll. So I like it that way. That's how I do it. I felt it's worked very well for me that way. I keep the interest rate really low. I've been able to afford that mortgage payment on top of my regular mortgage payment, and just keep building wealth outside of my home, but using the equity in my home to help me build that wealth and compound it. So hopefully that helps you out. Hopefully that breaks down the Smith Maneuver for you. Again, a lot of you have heard of it. You don't know how it works. It really is like, let's just simplify it. It's as you pay off your mortgage, whatever principal amount, you're borrowing back out, you're investing, and you're deducting the interest. That's really all it is. This is nothing more than that. I know we like to complicate these things sometimes. That's all it is. So you can do it that way. You can do it my way, which is, every 5 years when your mortgage comes up, take some equity in your home that you're comfortable with. Take it out as a mortgage or use it as a home equity line of credit and invest it that way. So there's a few different ways you can cut this. It kind of all works the same, depends how complicated you want to create. But at the end of the day, you're leveraging equity in your home. You're leveraging against that, investing it, and hopefully building more wealth. Again, it's not for everyone. In fact, I would say it's not for most people. So be cautious on this. Talk to your financial advisor, and we'll see you in your next video. Thanks so much.